because it's even harder than financial services reform, and that is that we have an incomes problem in this country. And that in a world in which you have stagnant incomes for half the population at the same time that the cost of housing, health care, and education keeps going up, you don't solve that problem with financial engineering. You don't solve that problem with credit. And if you try to solve the problem with credit and with financial engineering, you end up in approximately the situation we're in today. I think this is something that all consumer advocates need to remind the rest of the world of pretty frequently, because otherwise there is a temptation to make the financial system accomplish more than it is capable of accomplishing. And as soon as you do that, you open the door to a lot of bad behavior on the part of both the providers and the consumers. So a variation on that complicating theme is that we live in a heavily consumption-dependent society, not only in terms of consumer wants, but also in terms of our economy. I've been asked recently several times, what do you think about the savings rate? Is it going to hold high, et cetera, et cetera? And at the same time, you have even high administration officials not entirely sure whether they want us to save or spend. And so that is, again, a piece of this that we need to think about. Then, of course, we have the complexity of products. I'm sure you discussed that on the last panel. But I'm not sure you discussed the complexity of needs. I will, when I talk about what I think part of the right answer is, I will come out in favor of default products. I think it is a tremendously important concept that I'm really sorry got mixed up with ice cream and sort of totally trashed. But the fact of the matter is that different consumers, different groups of consumers, different consumers at different times in their lives have very different needs. And that it's very important as we think through the issues of how you do protection in a way that is responsive to those real needs. I'm as skeptical as at least some of the advocates about the notion of, if you make these rules, then credit will dry up and people will starve. No, I don't believe that either. But the point is that we do have to recognize that there are a myriad of needs. And then, of course, we have the complexity of the market. And so not only do you have lots and lots of players, but players of multiple types, and you have products that are substitutes for each other that are regulated in very different ways because they sit in very different institutions. So the classic example here is that insurance is a substitute for savings, certainly, and savings can be a substitute for credit. And so the question, and investment can be a substitute for savings and a substitute for credit. And so the question of how all of these things that functionally can serve the same consumer needs are regulated it's difficult enough if you just think about it in terms of banks. But you've got to realize it's not just in terms of banks. There are many other entities, some of which are subject to very different regulatory schemes that also produce the same kind of product. Then we have complexity of regulation, and the fact that Sarah is sitting here and that Jonathan is sitting here are just nice examples of the complexity of regulation. In Washington, we have this tendency to believe that everything happens in Washington, everything happens at the federal level. We have two of the best regulators who are not federal, although Sarah had a long history being one. These two people and their colleagues in many states in the country, in many cities in the country, do a fabulous job, not only of regulating in the sort of thou shalt not sense, but also, and Jonathan probably will talk about this particularly, in the making opportunities for consumers to get the right products happen. which is a critically important part of doing this well. And on the other hand, they have colleagues, and they have former colleagues who some of the worst federal regulators look like angels in comparison in terms of their willingness to actually step up to the plate and do what needs to be done with the organizations over whom they have jurisdiction. And some of it isn't their fault. I remember when I was at OTS and was being bombarded with the traditional preemption question, I had one state banking commissioner come up to me and say, would you please preempt all our laws because the state legislature won't let me do anything useful. Okay. And then we finally have the one that we have a tendency to forget about, but I think may be the most pernicious of all, which is the short-term profit pressures that almost all the institutions that produce these products are under. So my solution. Some of you have heard this before, but let's try it again. I do believe there needs to be a separate entity. I'm not going to have, we'll probably get into the discussion of whether it should be inside or outside the Treasury or blah, blah, blah. But I really do believe there does need to be a separate entity with rulemaking authority that is broad, national, and has primary jurisdiction. Separate from the bank regulators, preemptive where they write rules, not where they don't. I think this is a critically important distinction that gets lost really frequently. I know that there are people here who think it shouldn't be preemptive even if they do write rules, but the worst situation is when the federal government neither writes rules, doesn't write rules and nevertheless claims that they're being preemptive. It has to cover all substitutes, and it has to promote access and understanding as well as write prohibitions. And this includes research, it includes default products, it includes education and disclosure. Second, I would leave primary enforcement responsibility where it is now, where there is a clear enforcement entity. Some of this is straight out efficiency. I also happen to believe that while the bank regulators screwed it up the last time, there are tremendous potential safety and soundness benefits to having the regulation together. Now, why did it get screwed up so badly the last time? Well, some people will ascribe it to, they don't care about consumer protection. That is to some extent true. But I think there is actually a more structural reason, which is that for the very large financial institutions in particular, consumer products are treated as portfolios. It's a whole portfolio of mortgages and a whole portfolio of credit cards. And the safety and soundness regulators just do not look underneath the whole portfolio to figure out what's going on inside the portfolio and with the individual transactions. Now, the compliance regulators do. And where the regulatory system is working well, and I had this happen when I was at OTS. I know of cases where it's happened at the Fed. There are definitely cases where it's happened. Where it's working well, you will have the compliance examiners raising the red flag and saying, these people are really messing up on the consumer side with respect to mortgages or credit cards or whatever, on the compliance side, and they are doing it in a way that at the very least is going to generate a whole lot of reputation risk and lawsuits and things like that, but more probably is also going to generate a lot of bad loans. And you safety and soundness people ought to go over and take a look. And I know of a case when I was at OTS where that very dynamic kept an institution from failing. So I think it is important. I think it is useful. I would keep them together. Now, having said that, I do believe that this new entity needs to have the authority, and much more easily than would be available under the House bill, to jump in when they think something is not being effectively looked at. Now, how they're going to find it is an issue, and Julia raised the question of data sharing and things like that. I believe that can, in fact, be overcome, but there has to be an ability to back it up. And then the other thing that I think needs to be done, and this has almost as much chance, I think, as the FTC getting all the jurisdiction, but I will put it out there anyway, is the basic organic banking statutes, and while we're at it, the securities and insurance statutes too, really need to be amended to raise the level of importance of consumer protection in those basic organic statutes, and to do things like requiring one of the Fed governors to actually understand and care about these issues, requiring that the reports to Congress cover these issues specifically, or maybe even there's a second report, that you just have to raise the profile some. Is that a panacea? No. But if it's not done, I think that there will be the tendency to sort of slip back into business as usual. And then finally, I think substantively, there are two really important principles that ought to govern the substance of consumer protection. And one of them has to do with what we've been calling skin in the game. It isn't always capital. It can't always be capital. But there has to be some system to make those who are responsible for providing consumer products actually have some responsibility for the quality of those products. And then the other thing is that with respect to advisors, brokers, and others who are intermediaries, there has to be a much greater level of clarity as to that person's or entity's responsibility to the consumer. It doesn't have to necessarily be a fiduciary duty, but there has to be much more clarity than there is now. And with that, I'll turn it over to Jonathan. Or Sarah, you going first?
Sure. Okay. Happy to. Thank you. And I'm just so pleased to be here today, and essentially want to elaborate upon really what the current crisis has done at the local level, because what we have seen is that it really has been a fertile ground for understanding the regulator's role in consumer protection. And just to go back in time to sort of unwind what all these events have been in this crisis, you can think about it this way. We have had, first of all, a number of several and distinct waves, some overlapping waves, regarding foreclosures. So if you rewind back to 2007, at the state and local level, what we started to see were new spikes in foreclosures. And obviously what we were able to do at the state level is analyze the reason for each of these spikes. So for example, very early on, we started to see that it was an interest rate shock, right? That it was these new monthly payments driven by exotic products that were actually triggering the first wave of foreclosures. The next wave came about primarily through the fact that home equity was now starting to decline. So you started to see borrowers who were in over their heads. And now we're in probably, hopefully, the final peak of foreclosures, namely foreclosures driven by unemployment. The fact that people who are prime borrowers simply cannot be making their monthly payments. So at the state level, we've seen, these foreclosure waves, so to speak. At the same time, we're starting to see constriction of credit, right? So what we're seeing now is a real inability to access credit, and this has led to a proliferation in the usage of what a lot of people call the so-called fringe banking sector. The fringe banking sector, frankly, isn't so fringe anymore. It's really quite a massive part of the financial sector. So when we talk about these players, we're talking about check cashers, we're talking about payday lenders, we're talking about money transmitters, and we're talking about the variations that continuously evolve on these basic services. So foreclosure waves, constriction of credit, and, as Ellen has pointed out, an increase in consumer debt, right? So now we are dealing with the effects of really overdue consumer debt, which has really brought out much more innovative and increased activity by debt collectors. Debt collectors, by the way, they don't operate the way you might have thought historically they were operating. They now use the court system, and they use the court system to actually garnish wages against people who owe debts and who are afraid of showing up in court. So this is all just to give you a sense, really, of what we deal with at the state and local level, and what we've just been dealing with really since frankly 2007. And what all this activity really shows is that there are particular characteristics of a local response to consumer protection. And I want to talk a little bit about what those characteristics are, because I think they're important to keep in mind as we frame and look at what is at stake with the CFPA. First of all, one characteristic in the local response is that there are crevices, right? So every state will have a certain kind of regulatory structure set up for different industries. Well, those industries are going to take advantage of crevices. That's just what it's about, okay? And so, for example, in Maryland, payday lending, it was believed payday lenders were not able to operate in the state. Well, now payday lenders have found a new way to operate in the state, and that is through the use of brokers. So what we now see at the local level, and this is just over the line here in Maryland, is you will see the use of brokers who broker payday loans, and the wholesale providers of these loans are no longer dealing directly with the consumer, but are requiring the consumer to go to a broker, and the broker is putting fees on top of what the lender is putting on in terms of interest rates, and these fees and interest rates together are going way above the state's usury ceilings. So again, just an example of crevices being found in the law that will encourage new kinds of behaviors. A second characteristic of the local response: we deal with consumers as we find them, right? I mean, consumers are going to call their local office, either their city office, their county office, or their state office. It's the first point a lot of times where they call. What we do in Maryland is we have a whole group of people who answer calls and who try to deal with the problems and try to fix the problems. Now, what we've done in terms of trying to get consumers help is to obviously give them the kind of help we can, but at the same time start looking at trends, start looking at what these consumer complaints are really all about. So, for example, foreclosure crisis. You can imagine tons of calls coming in regarding people who are losing their homes. In the middle of some of these complaints, what did we learn? We were taking case histories, and sure enough, we learned that people were now dealing with something called, we're dealing with businesses called loan modification consultants. Well, this was something new. We hadn't heard of what these folks were. And it only came out really in taking these case histories. Well, it turns out that there's a new industry that has evolved called loan modification consultants. And these are the folks who will take an upfront fee. They require an upfront fee, and they will modify your mortgage for you. As it turns out, this became quite a trend, and we started to look at this and ultimately to enforce our laws against these folks. But again, it starts with consumers. As we find them, we deal with these problems. We are then able to detect trends, and this is again how we start to see at the local level that consumer problems are evolving. Again, I mention all of these because what we want to do when we think through these characteristics is think about how we take some of these features at the local level and transport them into a federal kind of response. The ability to legislate. States will differ on this. My experience in Maryland I've had a much easier time actually legislating in the area of consumer protection and in safety and soundness than I ever saw Congress able to do. And it's an easier kind of legislative lift, frankly. So as a result, we've been able to actually somewhat stay ahead of the problems, because if we're able to detect them earlier, alas, we should be able to tailor a policy response earlier and then ultimately be able to legislate a response earlier. So again, this idea of being sort of a first responder, taking the data as you find it and being able to translate it earlier into a tailored kind of policy solution is something that we do locally and is something that we'd like to see imported to the federal level. Finally, I just want to say a bit about enforcement. What does enforcement mean at the local level? I can speak for what we do in Maryland. Essentially, enforcement takes a range of options. We do administrative actions. So there are due process protections, and we will have hearings, and we will move essential violators into an administrative process and revoke licenses, impose fees, impose penalties, and order restitution to consumers. That generally is a very typical form of enforcement. More egregious behavior, we will collaborate and refer cases to a mortgage fraud task force, for example. So we have collaborated with the FBI, with federal enforcement authorities, as well as our state AG to actually bring cases with criminal ramifications. Similarly, we will work through consent orders, settlement agreements, and other administrative devices that will essentially move cases and send signals at a very early stage that unlicensed behavior is not to be tolerated. So it seems to me that one of the essential challenges we face in the movement towards a federal CFPA or some model of it is how to harness really the nimbleness and the ability at the state level to tailor solutions at a very early stage. How do we harness that to the benefit, really, of a federal consumer protection kind of apparatus? Something that produces a federal uniformity in laws, certainly, but how do we keep the nimbleness and the ability of the states to move ahead to protect its consumers and residents at an early stage?
Go ahead, we'll let her answer the question later.
Thank you. I would like to just keep listening. This is fascinating. I'd like to talk a little bit about the experience in New York City in the Bloomberg administration and what we have learned as we have moved relatively aggressively over the last few years from the classic consumer protection agency, which would give surveys on the price of roses at Valentine's Day, to one which really took on the financial services marketplace. And I think we have really learned three things that I hope are helpful in this debate. The first is you must move beyond classic outreach and education and really find and use literal enforcement tools. And cities and states as well have real tools that we have been out there using for years that are very effective. The second is I think you also have to be very strategic about using leverage. And as Ellen mentioned, we've been doing some of that in New York, and I'd like to talk a little bit about what we've learned by leverage points as well. And then third, I think you have to figure out how to sell it. And selling consumer protection to anybody except those of you in this room is its own special brand of sales. So first, in terms of using enforcement tools, cities are on the ground, as are states, in their ability to literally step in and regulate the behavior of key industries that are impacting the lives of those with low and moderate incomes. So, for example, in New York, we literally license debt collectors. We license employment agencies. We license pawnbrokers, used car dealers, et cetera, and can set and enforce rules for their behavior. the fact that one can do that, and the debt collection example is particularly interesting because debt collectors from all over the country are looking to collect debt from New Yorkers, but all of them need to do so with a New York City license, abiding by very specific New York City laws and rules about the way in which they behave. And as Sarah mentioned, at the same time, the minute something goes wrong, we hear about it, because we're the ones that you call. We can figure out not only where to step in with bad players, but from a larger perspective, where the new problems are. And so our ability to license, our ability to hold public hearings, to issue subpoenas, is how we came across the new industry of debt buyers. And we're able to move very quickly in New York to be clear that debt buyers also fell under the regulatory scheme of New York. We did that first by letter of interpretation, and it was done, and then strengthened it a little bit by local law. So cities are able to be very quick about affecting the behavior of an industry, and particularly when you have a city as large as New York and some of our partner cities out there, when you change the rules of behavior in a major marketplace, you begin to have a ripple effect about the way that behavior is seen throughout the rest of the country. So that can be very important. We have a coalition of cities called the Cities for Financial Empowerment, and in these many cities we have seen various approaches beyond licensing and litigation that also go into using zoning. There are very creative opportunities for cities to have immediate impact on industries of high concern. All that having been said, we need a lot of help. There are clear limits to what a city or a state can do. I think many of us have been in the room, either publicly or privately, when banking regulators have talked about the very real threat of financial institutions leaving a state regulatory scheme to avoid being held accountable for certain consumer protection approaches. As one example, the preemption issues are complicated and no fun, and call for the ability, if you're really going to regulate behavior rather than just try to influence it, and if you're going to try to do so in a sustainable way, can only be done at a federal level. And so even in a city that has taken very aggressive approaches to trying to regulate the financial services marketplace as much as possible, and I'm not one to give up power, I can assure you, it is absolutely critical to us that the federal government continue with this movement toward the kind of sweeping reforms that are required if you're really going to influence the behavior of financial institutions. I would put a note in here, as Ellen mentioned and others have, regarding preemption. It would be ironic, to say the least, if the biggest step forward the federal government ever took on consumer protection turned out to be the worst thing that ever happened to local consumer protection at the same time. There is no reason that should be true. The trite model that I would advocate, or the trite articulation of the model that I would advocate, is the floor, not a ceiling approach. There is no reason, I think, for localities not to be able to step up those protections. The other thing I think we have to be frank about is it is at the local level that you can literally enforce. There is something very real about, I love being in Washington, but there's something very real about being in the middle of the city that you are regulating and being able to touch the flesh of those that are leading industries, of the large players in the industry, to be able to use your power to change those behaviors. Which leads to my second point, which is using those powers not only as a municipality, but also as a regulator of a lot of these industries, albeit at a local level, to leverage those opportunities to create new ways that consumers can be served that aren't necessarily about the do's and don'ts of a law. So in New York, for example, we have used our credibility and some leverage points. Remember, cities touch people. We touch them in a number of different ways, particularly those that need help. And so our ability to create opportunities where we are saying to the banks and the credit unions in New York, and there are a lot of them, we're about to roll out some new program. We want this program to be dumping these dollars into safe financial opportunities. And in a couple of cases, we've literally said we've designed a safe account. Who's in? And that model of not regulating the financial institution, which we can't do, but instead leveraging the access to these populations and trying to change the calculation a little bit for these financial institutions about whether it's worth it to them to wade more carefully or more, expansively into low and middle income markets that they have otherwise shied away from. And so, without saying the ice cream term that I loved Ellen making fun of, I do think that there are ways to develop, and in New York we have developed already a suite of products that we have, some 10 different institutions that are all offering the same product. People respond to the use of government credibility and government access. So let me just give you one quick example to explain what I mean. We had a program where we had a large group of people we expected to be largely underbanked, who were going to be receiving regular disbursements of money as part of an experiment. What we did was we went to the banks and credit unions, we pulled them all together, we said, here's a safe ATM-based account. There will be no overdraft, there will be no fees. And anyone who wants in can be on the menu. We walked away with 10 of them, 5 banks and 5 credit unions. And at the moment that these people were, again, in our grasp, signing up for a program that they needed and wanted to be a part of, we signed them up for bank accounts. We went from a population in this group, 58% of them were unbanked as we were signing them up, and at the end of the process, only 8% of them were. So the model of getting people to take advantage of these opportunities is vast. That's a huge take-up rate, obviously, and to this day, 98% of them still have those accounts. Why did they take the accounts? Well, behaviorally, economically, it couldn't have been easier. It was at the moment that they were already signing up for something that they wanted, and because we were using the mayor and the city's good name to say, you're not going to get screwed. And people gave it a flyer, and it worked, and they didn't get kicked out of the system a few months later, and so they've kept up using those accounts. And so that's an example, I think, of where, and one of many, where leverage really makes a difference, and you can accomplish things without necessarily regulating. And I would hope that a nimble Consumer Financial Protection Agency, even at a national level, would be thinking about ways in which you could create opportunities for financial institutions to be a part of and get credit for, beyond CRA, to get credit for good work. One of the ideas that I've thrown out there with a colleague at our State Banking Commissioner, Richard Neiman, is the idea of a rating system. If it's politically unpalatable for the CFPA to be mandating default products, then why not mandate a rating system about the complexity of products, for example, or the risk factor in products, and mandate the disclosure of that rating system? There's an example of where I think you can be very creative about and very clear to consumers about whether or not a product is safe. I'm oversimplifying a little bit, but I've got the microphone. Finally, the third point I would say before we move into the conversation is I think it's really important that as to how you sell consumer protection. You'll rarely come across somebody who will say, even in private, I'm opposed to consumer protection. Instead, what you'll find is well-meaning people who have larger priorities who say, yeah, consumer protection is great. Now let's talk about what I really care about. I think that in the debate on the CFPA, you have seen self-interest and millions of dollars, and that's the way the system works, decrying how terrifying and potentially disruptive the elevation of consumer financial protection could be. On the flip side, I fear all you have seen is general bromides about how important it is to protect consumers. I don't think people can sink their teeth into what consumer protection means. I think you have to be quite literal. And I think that for this debate to get juicy enough, for people to start putting pressure on their legislators to start helping them rather than participate in this sort of who's who of protecting the people that have gotten into this mess, I think you have to be very specific about what we're talking about. I think you need to talk about what's happening at a local level on refund anticipation loans, what's happening at a local level on payday loans, what's happening at a local level on debt collection. You can be very specific about the harm that's being done, and you're suddenly going to find that the people who are listening have experienced it themselves, know people that have experienced it, have reams of data back at their office or at their colleague's office about that experience occurring in their locality as well. And suddenly what you're talking about is a literal problem with a literal solution rather than one that's figurative. I think with consumer protection, as my 10-year-old niece would say, you have to go there. Thank you.
So let me start by asking both of you. Both of you seem to be saying there are tremendous values at the local level. We're first responders. We're smaller. Some of our legislatures actually work. Some of us are in states where the legislature is a little less effective.
I can neither confirm nor deny.
You know, we have a whole operation in California, and the only good thing about New York is that it makes California look somewhat more put together. But how? So all of those advantages are real. There's no question about it. But how do you then mesh that with what you seem also to be saying, which is the big players are national. There is this tendency for race to the bottom. New York lost a lot of charters because of whether it was preemption or something else. In any event, New York lost a lot of charters. How do you square the two? What are the kinds of things that you would want to see in a federal entity that would work effectively with you? Sarah, you want to start?
Sure. Really just an excellent question, Ellen, because what it does, it's going to mesh really what kind of lessons we've learned at the state level dealing with this crisis with what we can be doing at the federal level. Couple things. First of all, I think we all need to realize that what was done in the House bill is probably going to be the high water mark in terms of a consumer protection agency. That said, there are now obviously debates regarding where a possible new agency or division could be housed, and I think that the political reality is that there are several people in the Senate who don't want to see the creation of a new agency, but for whatever reason they find it more palatable to house this in a different place because it won't be the creation of a new agency, it'll maybe just be a division or something else. Something I think to keep in mind on that front is that it's probably pretty dangerous to house a consumer financial protection agency with a chartering authority or near a chartering authority. You talk about issues regarding, you've heard in the prior panel, regulatory capture. There's been a history of federal regulators looking for turf, those that chartered, and you can see the potential for deals being struck in which, once again, consumer protection issues will get subrogated. Not good. Now, clearly, the idea of having something at Treasury is, I guess a possibility, but you also have at Treasury the OCC and the OTS currently, and I know that there are indicia of independence that are associated with those agencies, but again, I think that would need to be explored if, in fact, that becomes a potential home. The idea that Travis brought up of housing it at the FTC may be more palatable from the perspective of independence. But again, we need to look at where it eventually gets housed and that it not be too close to the federal to a federal chartering authority. Again, and I know this is said over and over again, but there need to be explicit mandates and mechanisms for coordination and information sharing, because if it's anything we have learned, it's that we see these problems emerge early at the state and local level. We see them there first. How do we harness that and get that information moved very quickly to a federal regulator that's able to do something with the data, not just sit on it and wait for more complaints to bubble up, but actually do something in a very tailored and effective regulatory way. So again, the importance of explicit mandates and coordinating mechanisms. Funding. Hasn't been a lot of discussion this morning about funding, but clearly we need to think through the funding piece of this and make sure that it doesn't impose a disproportionate burden on any particular subset of regulated entities. Funding should really be commensurate with the cost of regulating, in essence, what it's costing to regulate that particular group of institutions. Finally, and I know it's trite, but floor, not ceiling. Again, it's critical that at the state and local level we be able to target particular policy responses to particular problems. To the extent a federal regulator can do that and do it quickly and do it effectively and do it with not a lot of unintended consequences, terrific. Unfortunately, that hasn't been what we've seen historically. The idea here is to try to target particular problems. Again, an example to be real. In Maryland, when we started seeing a lot of modification activity begin, we realized actually that we had some kind of authority, regulatory authority over mortgage servicers. So we very early, and this is now early 2008, put in place a mortgage servicer reporting requirement where we could start looking at the modifications being done by mortgage servicers and whether they were sustainable. Because first of all, we all thought, okay, let's just modify. That's going to be the measure of success. Well, we early on then realized, well, wait a minute, you can modify and still move to a foreclosure. So that's not exactly the right measure. Let's now tailor this to be even more specific. And we can do this. We can do this well before any federal regulator even thinks through how to reach consensus in such a way to move it into the national sphere. So again, I like to say the states can be a laboratory here of regulatory innovation. We can try things. Some will work. Some will not work. We can scrap them easily. We can start them if need be. We can modify them. That's, again, a feature that we want to maintain, and I think you can do that with the floor, not ceiling approach.
I was just thinking real quickly, I see this in sort of, from my perspective, I see two categories. One is those areas where cities, speaking for cities, really can't do much. So when I look toward how the Fed's new regulations regarding opt-in to overdraft are going to work, my hands are tied. And that's no fun. But then there's a second category, and so obviously we would welcome, more targeted enforcement.
What I
Can I do something?
What I hear you saying is that because the institutions are national, because of competitive pressures and things like that, you couldn't have solved that problem yourself.
I couldn't have solved that problem, nor moving forward can I be part of a local solution to make sure that a federal effort at reform is effective.
Okay.
Right? I would say both. I can't be out there,
Right.
As we're starting to hear already about some very troubling approaches that banks are considering in marketing to their customers, new and existing, about overdraft. And, we at a local level, we tend to, beat the crap out of people who are deceptively advertising to consumers.
Right.
My hands are tied behind my back in this regard, and so federal oversight is obviously very welcome, and that's, there's such a significant concern there. But the second category that I see is where localities can add additional bang to the buck. And I mentioned our ability with advertising. Our ability to go after those who are deceptively advertising their goods or services is a very powerful local tool. Sometimes I call it a sort of our Al Capone approach to enforcement. I maybe not get them on their actual activity, but I can get them on the way they advertise it. And so in those cases, again, we would welcome very strong federal protections because we could continue to make sure at a local level, as you say, more nimbly, that those protections really were working out.
So, for example, on the overdraft thing, and I'm not entirely sure what the division of labor between New York State and New York City is, but if you saw deceptive advertising from a state-chartered institution, could you do something about it?
My general counsel will quit if I answer that question.
I won't force you to. So I have, let me ask one more question, then we'll put it open. Both of you talked about the litany of folks who you license. And I think one of the successes over the last couple of years has been this issue of the SAFE Act and the licensing of mortgage brokers. Are there similar systems that are needed and could be effectively implemented to deal with, maybe not mortuaries and hairdressers, but debt collectors and others?
Sure. There clearly are, Ellen, and you're right. The nationwide mortgage licensing system really was a great model in terms of licensing and an effective, robust system. And incidentally, it is a system that, while designed for mortgage brokers, mortgage originators, mortgage lenders, has the capacity to actually be unleashed, so to speak, for all other kinds of entities. So it is a fairly powerful licensing system, and it does stand as a very good model for what can be done regarding other kinds of licensing protocols. Licensing is important. I mean, but it's a complex area because what you typically have is you'll have the emergence, say, of a new kind of business, a new kind of activity that maybe you haven't seen before. And you ask yourself first, does this fit within one of the state's existing regulatory and statutory authorities? And it's either yes or no. Now, when you look at it, you're going to also there are going to be a number of people who say, well, this is something the state should not get involved in. In other words, let's not license it. Let's just let it play out and see what happens. And clearly there are those kinds of arguments that you will have heard. You'll also have heard a question of whether you want licensing or whether you want registration. And there are there's a difference there. Registration is a mere, send in your name, address, and a contact point, and then that's it. There's no other state touch point on that. Licensing tends to be, not always, but tends to be a little bit more robust. And the licensing structure is one at the state level that we can adjust in the sense that, you can clearly after the mortgage crisis, there was a sense in many states that the mortgage licensing system really was not as robust as it could have been. What does it mean to have a more robust licensing system? You look at things like education requirements, criminal background checks, knowledge of the industry, years in the industry, surety bond is often required. So licensing systems themselves have various different components, things that you can sort of modules, as you might want to think of it, and you can move things in and out based on how your legislature really wants to license that particular industry.
I would just add, I think there are ways to scale up protections as you see them, and you should only regulate when you see a problem, not just because it looks good. But licensing can be an incredibly powerful tool. I mean, just to give you a few examples, I said we license debt collection. We literally we tell people, debt collectors, how early in the morning they can call, how late at night is too late, who they can't call, what they have to say on the telephone, what they have to do if a consumer requests information in writing. It can be very, very specific in regard to targeting real problems. And so you can literally change behavior in the way that certain industries operate. In addition, I have mediators who handle the individual consumer complaint calls. There is a vast difference between a phone call to a business that has done wrong, perhaps by a consumer, that we license, who will answer our questions and who will be responsive to our concerns, in part because losing a license puts you out of business. And so in the used car industry, for example, it's a very powerful, difficult weapon, an awkward weapon to have to use, but sometimes you literally shut a place down, and that sends a shockwave throughout the industry as to how the others need to behave or what the consequences will be if they don't.
The other thing I would just add to that, licensing is really just one facet, too, of regulation. I think then we also ask ourselves, at the state level, licensing is sort of the barrier to entry. It's just sort of the keys to the door, so to speak. But once you're in the door, what are you going to do about it? Are you going to examine? Are you going to engage in any kind of rulemaking? Are you going to enforce rules that are on the books? So you don't want licensing always to just exist in a silo. You want to think through how licensing is going to interact with other facets of regulation, meaning the examination function, the rulemaking function, the enforcement function, and we do that at the local level.
Okay, let's open it up to questions. We've got one up front. Oh, he's coming fast enough.
Mr. Mintz, I would request if you could elaborate on your statement that you think at the federal level that there should be more incentives beyond CRA for safe products for low and moderate income people. I mean, just maybe specifics. I know New York City has done some things, but what specifically are you talking about?
Well, I think there are a number of ways to do it, and some of our local examples are a couple of approaches. One is that you literally create high visibility opportunities and use frankly, the PR leverage to entice institutions to cooperate. And so, as I said, in a number of our banking opportunities, initially our success in getting banks and credit unions to offer a product that we designed that was safe, that nobody was forcing them to offer, is because they were going to be part of a very high visibility program. And they got a lot of credit for it. A second form of enticement is about access. Again, there is a really big difference between putting a poster up and saying to people, it's a good idea, you should go do X, as opposed to being at the point where people are signing up for some program that they care about, and at that point using, in our case, a city-vetted, leveraged, designed product and signing people up. I'm obviously not going to go say to somebody in a workforce development site, it'd be great if you went to Bank of America. They've got some great products. But I would say to them, we have the NYC Safe Start account. Here are 10 different institutions. You can choose which one, but you're not going to get screwed. And so I think that's one way that has nothing to do with regulation. It's just about smart leveraging of opportunities.
So, Jonathan, have other institutions come onto your list or in different programs, follow-on programs, have you been able to attract different institutions?
It's an excellent question. Stay tuned. I would say so far all of the institutions that signed on have stayed on, and one of the reasons that they've stayed on is not just the PR, but that they are also doing cross-selling, which I think is, to be honest, unavoidable. We made a policy call that we were not going to try to take, quote, our customers and put them in some sort of a bubble. That wasn't possible. What we did want to make sure is that from a policy perspective, we got people back into the banking system or first into the banking system and could have a safe experience and that they could begin to know the difference. As we move forward, there's a bit of a snowball rolling down the hill component. More and more of my partners in city government are now coming to us to offer these types of products to their particular populations. And as I say, even small pilots in New York tend to have large numbers of people. And so with the addition of larger populations, we are now seeing interest from larger institutions.
And just by way of full disclosure, AutoSave, which is a joint program with New America and MDRC, New York City has been a major participant. And Alejandra, are you still here? Yes, Alejandra's in the back there, and if you want to learn more about AutoSave, she'll be happy to tell you.
Well, and this is another good example. New York is the largest employer in New York, so we have 330 or so thousand employees, and so the ability to pilot with us as an employer is another type of leverage where you can really be smart about offering a large market share and proving to institutions and or to policymakers that it can work.
Another question? Yes.
Ellen, you mentioned the SAFE Act and the licensing paradigm that it set up. I also think the SAFE Act is an interesting response, in effect, to those who talk about, states left to their own are going to create sort of a balkanized system. I was wondering if Sarah would comment on the state's experience in implementing the SAFE Act and the state-federal relationship there.
And Sarah, I'm going to piggyback on that because I'm going to use that question to ask you to also comment on what do you do with your recalcitrant colleagues?
Sure. Okay, recalcitrant colleagues. In terms of the SAFE system, it's very interesting because Margaret is correct that there was a sense when the SAFE Act was passed that it was going to take forever to get all 50 states on board. Now, for those of you who aren't real familiar with the intricacies of the SAFE Act, primarily the SAFE Act required all 50 states to pass a mortgage lending system, a regulatory system that contained specific kinds of provisions. Okay, so the federal law mandated that the states needed to take action, needed a system, and needed new laws on their books that contained various provisions. A lot of people looked at this and thought, oh, this is going to be a huge headache because it's going to take forever to get all 50 states to go through their legislatures to actually pass every single item that the Congress mandated. Lo and behold, I think 49 states have now done it. This is legislation that is fairly new, federal legislation, and yet all states, with the exception of maybe one, have now done what has been mandated by law. So I think it is a powerful example. I think it does stand for the proposition that states will do what they have to do if mandated by Congress. And I think it also goes to a point that Julia Gordon raised, at the earlier panel. When Congress legislates, and that's always an option, right? That Congress can legislate in these areas. When Congress legislates, if Congress requires the states to take action or for other authorities to take action, look, at least in my experience, it happens, and it can happen, and we now know it does happen.
Who hasn't passed
I'm not sure I know. Do you happen to know?
Minnesota, but they intend to introduce, it hasn't been introduced, but they introduced this.
Another question?
You want me to address the recalcitrant colleagues?
The recalcitrant colleagues, particularly when that big state out there in the West.
It's interesting because the state system, every state has a banking commissioner. And these 50 bank commissioners themselves comprise a state system of regulation. And people, I think, have at the federal level have looked in at the state system and thought, 50 states, what kind of system can that be? It actually is quite a functional system. I can't say that all 50 states, that we all march to the same drummer, because we don't. But the virtue of the fact that we don't actually, I think, turns out to be a real benefit for us. What we essentially do as a system is we sit down regularly to talk through trends, to talk through regulatory developments, to talk through what we are seeing. And we do this on a fairly consistent basis, all 50 commissioners. Also, what we do is we meet regionally. So we divide ourselves into groups that essentially where we have similar conditions. So, for example, Maryland is in the group of states primarily of Middle Atlantic and New England, northeastern states. And that tends to make sense because we tend to have similar economic conditions, but, again, not exclusively. So we sit down on a regional basis and we talk through what we are seeing on the ground level, what we see emerge, and how we're dealing with these issues. The state system, I would say, does work. Now, recalcitrant colleagues, I think, for all I know, I'm one of them, so I'm not quite sure how to deal with it. But we look to each other for advice. It's interesting. People are generally appointed by their governors, so they come from a mix of party perspectives. And yet, I would say that all 50 commissioners do believe in the importance of state regulation. and in the dual banking system. And so that, I think, binds us and pretty much keeps the dialogue always moving forward.
And on this issue of multiple kinds of institutions selling products that are very similar, some states have highly unified regulatory systems. Vermont, for example, where just about anything you can do is under a single commissioner. And others have much more diverse. So in California, the commissioner actually doesn't have jurisdiction over a lot of the regulatory issues. How do you deal with those?
Well, we deal with them. I mean, somehow we deal with them. So, for example, when we have conversations that are just bank specific, we will include the commissioners who have purely bank regulatory expertise. Similarly, we have parts of our discussion that are then devoted to the non-bank products, and people sort of know when they're needed and know when they're not.
Just real quickly, that's also true at the city level. Where financial empowerment efforts reside, for example, in our coalition, is very different from city to city. You find your partner.
Okay. Reed, do we have time for one more question? But I don't know that we have a question. Do we have any more questions? Okay, I think we will take this opportunity to thank you all for coming and to thank our panelists, and have a good day.